Welcome to the deep dive. Today, we're really digging into some practical ways you can manage your money more effectively.
Yeah, exactly. We've looked at a bunch of ideas around financial mindsets, different systems people use.
And the goal here really is to give you tools you can actually use,
Yeah,
things that help you get control, no matter what you're earning right now.
absolutely. We want you to walk away feeling like you can move towards, well, better financial security, more opportunities. It's about action.
It really is.
Yeah.
And, it's funny how differently people approach money. I remember seeing in families, sometimes it's all about saving every penny, almost fearfully.
Or the opposite, right? Spending to maybe project a certain image, external validation stuff.
Exactly, that idea that you need to look successful.
And it's a good reminder that money itself, it's neutral, isn't it? It just sort of amplifies what's already there.
How do you mean?
Well, if someone's naturally generous, more money might just mean bigger generosity. But if someone tends towards, let's say, less ethical behavior,
Oh, right. More money could just amplify those negative traits too. That's a sobering thought.
it is. Which brings us back to the core point. It's not just about how much you make. Your financial future is truly shaped by what you do with the money you have.
Okay, so let's talk about the bigger picture for a moment.
Yeah.
You mentioned different financial paths people end up on.
Yeah, if you look broadly, you often see like three main groups based on long-term habits. It's not exact science, but it's a pattern.
What are those groups?
Well, you might have, say, the top 5%. These are folks who often manage to build generational wealth. Think, maybe a net worth starting around $5 million, house paid off. They're focused on legacy.
Wow, $5 million. That's significant. But the key isn't just the number, is it? It's the mindset, the consistent focus on assets over just spending.
Precisely. It's about prioritizing differently. Then there's maybe the next 15%. You could call them the comfortable middle class.
Okay, what does that look like?
Think owning your home, having some solid savings, being able to take vacations without major stress. Maybe someone with, $1 million net worth, their house clear, some long-term investments humming along.
Right, a comfortable position built over time.
Exactly. And then, then there's the larger group, maybe around 80%, who might find themselves needing to work much later in life or relying on support systems.
And that's often linked back to those long-term money habits we talked about.
Often, yes. But look, the point here isn't judgment at all. It's about understanding potential outcomes based on the choices we make consistently. We want to give you insights so you can look at your own habits, make informed choices.
Makes sense. So let's get practical. What's a common trap people fall into, especially if they're like self-employed or have a side gig?
Ooh, a big one. We call it the personal account trap. It happens all the time.
Personal account trap. Explain that.
It's simply when your business income from your freelance work, your Etsy shop, whatever, just goes straight into your personal checking account.
Okay. Seems straightforward. Why is that a trap?
Taxes. The big issue is you often end up overpaying your taxes. Massively sometimes.
How so?
Because when all that money is mixed together, it's really hard, almost impossible to properly track and claim all your legitimate business expenses. Things you could be deducting to lower your taxable income.
Ah, I see. So you're missing out on deductions because everything's jumbled up.
Exactly. You lose that clear separation.
So what's the solution then?
Incorporation, or at least forming a distinct business entity. Setting up something like an LLC, a limited liability company, or maybe an S-corp.
LLC, S-corp. Heard those terms. What's the benefit?
Well, fundamentally, they create that legal separation. Your business becomes its own person, financially speaking. An LLC gives you liability protection, which is huge. An S-corp can have some tax advantages, especially as you earn more.
The money flows into a dedicated business account first.
Yes, that's the key. Income hits the business account. You pay your legitimate business expenses from that account. And then you pay yourself or determine your taxable profit. It cleans everything up.
So for anyone listening who's earning business income, even just a side hustle, this is something to seriously look into.
Absolutely. It's not just paperwork. It translates into real savings. It's one of the first things I usually recommend people sort out.
But choosing between an LLC or an S-corp, that sounds potentially confusing.
It can be, and that's why professional advice is so important here.
You mean talking to an accountant?
Definitely.
Yeah.
A qualified accountant is your best friend here. They'll look at your specific business type, where you operate, your income level, your goals, all of it.
And help you choose the right structure for you.
Precisely. It's not a one-size-fits-all thing. Get personalized advice.
Okay, so incorporating tackles that personal account trap. Great first step. What comes next in terms of organizing things? You mentioned a checks mentality earlier.
Yes, the checks mentality. Think of it this way. As soon as money comes in, you're mentally writing checks, or maybe uh, digitally transferring funds to specific jobs.
Jobs for your money.
Exactly. The core idea is having dedicated bank accounts for specific purposes, creating separate buckets, essentially.
Okay, like different jars for different goals.
Kind of like that, yeah. At a minimum, we strongly suggest having 3 key accounts.
3 accounts. What are they?
First, a dedicated business account. All business income goes in, all business expenses go out. Simple.
Okay, business. What else?
Second, a tax account, specifically for setting aside money to cover your income taxes, self-employment taxes, whatever applies.
Tax account. Got it. And the third?
Third is your home or personal account. This is for your living expenses, rent, mortgage, food, utilities, personal stuff.
Business, tax, home. Makes sense. So what's the mentality part?
The crucial habit is this. Every single time you get paid, any income that comes in, you immediately split it across those 3 accounts. Don't wait.
Immediately.
Yeah.
Like right when the deposit hits.
Right then and there, it needs to become automatic, a non-negotiable step.
Okay, let's walk through an example. Say someone gets a $5,000 payment for a project. How would they split that?
Good question. A common starting point, though it needs adjusting for individual situations, might be roughly a third, a third, a third.
So roughly 33% to each.
Yeah, as a baseline. So for that $5,000, maybe around $650 goes straight into the tax account.
Okay, $650 for taxes, set aside immediately. That feels proactive. Takes the staying out of tax time, I imagine.
Hugely. You're basically paying your taxes bit by bit with every payment. No more year-end panic trying to find a huge chunk of cash. Especially if you're incorporated, you'll work with your accountant on the exact right percentage, factoring in deductions, but this sets the habit.
Right, avoids that big surprise bill.
Mhm.
Okay, so taxes are handled. What about the rest?
Another $650 roughly goes into the business account.
And the purpose of that is?
That's your operating hub. Software subscriptions, marketing costs, supplies, maybe paying contractors, professional development. Anything related to running the business comes out of this account.
So it keeps business spending totally separate. Gives you a clear view of whether the business is actually profitable.
Exactly. You see what's coming in, what's going out for the business itself. It helps you make smarter decisions about where to invest in your business.
Makes sense. Okay, tax, business. That leaves about a third, maybe slightly more, like $1,700 from the original $5,000?
Correct. And that remaining amount, the $1,700, goes into your home or personal account.
That's the money for, like, everyday life. Groceries, rent, gas, going out.
Precisely. Your living expenses.
Right.
And this is really critical. Just because that $1,700 lands there doesn't mean it's suddenly free-for-all fun money.
Ah, right. You still need to manage that money, too.
Absolutely. You still need a personal budget for that home account. You need to know how much is for rent, how much for food, how much for bills. The 3-account system provides the structure. The personal budget provides the management within that structure.
Okay, so the system sets aside the money, but budgeting tells it where to go within the personal category.
You got it.
This whole checks mentality, the 3 counts, it sounds like it could really bring some, I don't know, peace of mind. What do people say when they actually start doing this?
The feedback is almost always really positive. People report several key things consistently.
Like what?
Well, first, they often start actually building savings
Yeah.
because they're not accidentally spending money that should have gone to taxes or business costs.
That makes sense. It stops the leakage.
Exactly. Second, way less stress around tax time. We mentioned that, but it's a big one. Knowing the money is already set aside, huge relief.
I can imagine.
And third, they find they actually have money in the business account when they need it. For expenses, sure, but also for opportunities that pop up. Some even build up enough profit in there that they can start taking formal distributions or dividends.
So paying themselves profit from the business
Mm-hmm.
on top of their regular draw for living expenses.
Potentially, yes. Once the business is healthy enough, it really shifts the feeling from money just vanishing to actively directing it.
It sounds empowering, but, okay, let's be real. That $5,000 payment hits the bank. There's always that little voice saying, ooh, maybe a new gadget, a nice dinner out. How does the system help fight that impulse?
Yeah, that little voice. Yeah, we all have it. But this system creates a natural pause, doesn't it?
How so?
By forcing you to split the money first, tax, business, home, product, you're prioritizing the structure before the splurge. You're dealing with your obligations up front.
So you see what's actually left for personal spending only after the important stuff is allocated.
Exactly. It puts a buffer between the impulse and the action. It also starts to clarify the difference between, say, debt that might build wealth.
Like a mortgage on a rental property.
Right, something that could appreciate or generate income versus debt that just erodes wealth.
Like high-interest credit cards for stuff you don't really need.
Precisely. The system encourages you to think more about that long-term security instead of just the immediate gratification.
Okay, so the 3 accounts, business, tax, home, that's a really solid foundation.
Right.
What if someone wants to take it further? Thinking about building more significant wealth, maybe that generational thing we touched on.
Yes, there's definitely another layer you can add. It's often part of cultivating what people call a wealthy mindset, though the principles really help anyone. We introduce something called a financial hub.
A financial hub. Okay, sounds central. What is it?
Think of it as like a central clearinghouse, an intermediary account that money flows into after the initial three-way split.
So money moves from one of those first 3 accounts into this hub.
Typically, it's surplus money. So maybe you budgeted carefully in your home account and you didn't spend everything allocated. That extra goes to the hub.
Instead of just sitting in the checking account tempting you.
Exactly. Or maybe you take some profits out of your business account that could go into the hub too. Often this hub account is actually an investment account of some kind.
An investment account. Okay,
Uh.
so back to our $5,000 example. We put $1,700 in HOMA. Let's say we only spent $1,500 on living costs that period. What happens to the extra $200?
Instead of just letting it build up randomly in the home account, you'd intentionally transfer that $200 surplus into your financial hub.
Okay, the $200 moves to the hub.
Yeah.
What's its job there? Just sit there.
No, the hub is where the really strategic long-term allocation happens. From this central pool, you make deliberate decisions about directing funds towards specific wealth-building goals.
Even if it's just small amounts trickling into the hub.
Absolutely. Even small amounts allocated consistently and strategically add up significantly over time. The discipline is key, regardless of the dollar figures.
Okay, give me some examples. What kind of allocations happen from the hub?
Well, a big one is retirement savings. A certain percentage of whatever lands in the hub should consistently go towards your retirement accounts, 401k, IRA, whatever you use.
Got to feed the retirement fund. Makes sense.
Compound growth needs fuel, right? Even small, regular contributions make a huge difference long term.
Okay, retirement. What else?
You might allocate another percentage, say maybe 5% or 10% of the hub's inflow, into a separate savings account specifically labeled cash for investment property.
Ah, like a down payment fund for real estate.
Exactly. Maybe you're aiming for a duplex or a small rental, systematically putting aside even a small chunk from every surplus or profit distribution. You'd be surprised how quickly that can build.
So you could save up a down payment over maybe a couple of years just from these surpluses.
It's definitely possible, depending on the amounts and consistency. And then that property starts generating passive income, which could potentially flow back into the hub, creating a positive cycle.
That's powerful. Building assets that generate more income. Okay, retirement, real estate fund. Anything else from the hub?
Yeah, it's also smart to allocate for personal growth courses, books, conferences, and even, planned fun or discretionary spending.
So a fund,
Mhm.
but one that's intentionally filled.
Right. It's not just whatever's left over. You decide, okay, X% of the hub surplus goes towards travel or whatever your goal is. It gives every dollar a job saving, investing, spending, learning, enjoying. It's all planned.
I like that. Planned enjoyment. It feels less guilty somehow.
It does. Because you know the important stuff is covered.
Now, throughout this, we've used examples like 33% or 5%.
Mm.
It's really important to stress these are just examples, yeah.
Oh, absolutely crucial. Your percentages will be unique. Your income, your cost of living, your tax rate, your specific goals, it all changes the math.
So people need to customize this.
Definitely. And this is another point where talking to a qualified financial advisor or planner is incredibly valuable. They can help you look at your numbers and design a system and percentages that actually work for your life.
So treat these as guiding principles, not rigid rules. Understand the why behind it.
That's the key. Understand the principles of separating funds, prioritizing obligations, and allocating intentionally, then make it your own.
Okay, so wrapping this deep dive up, if there's one big takeaway, what is it?
It's really the fundamental importance of taking active, intentional control. getting out of passive mode with your money, and putting a system in place no matter how simple it starts.
And this isn't just for high earners, right?
Not at all. This applies to everyone. It's about making the absolute most of whatever resources you have right now, being in charge of your finances, not letting them just happen to you.
Shifting from reactive to proactive.
Exactly. But, hearing all this is one thing, doing it is another.
Right. Information is great, but action is what changes things.
So maybe the final thought for everyone listening is, what's one specific, concrete action you can commit to taking, say, in the next 30 days?
Just one thing.
Just one thing to start. Maybe it's opening that separate tax account. Maybe it's roughly calculating your own percentages for the 3 accounts. Maybe it's making that call to an accountant or financial advisor.
Something tangible to move from listening to doing.
Precisely. Get that first bit of momentum going.
This has been incredibly insightful. Remember, this deep dive is really a starting point. Keep exploring, keep learning, and definitely consider getting that personalized advice. Thank you so much for breaking this down for us.
My pleasure. Thanks for having me.
And for all of you tuning into The Wise Shelf, if you found this helpful, please do subscribe to the channel. We bring you financial wisdom every week to help you keep growing smarter and richer. We'll see you next time.